The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Hi, my name is Nicola, and the webinar is going to start soon. We had a lot of attendees on our LinkedIn event, and we're just gonna wait for more people to show up and listen to this webinar on commercial real estate investments and analysis. So while we wait, I want to introduce myself again. I am Nicola Dimitrovski. I'm an international training consultant for LEORON. LEORON, as some of you know or may not know, is one of the top educational providers in the world, and especially for the MENA and GCC region. We offer a variety of training courses. We offer flexibility in creating your own training course as an in-house on a topic that you might like, that you want to hear, or your employees to hear. So for everything that you are interested in, everything that is unclear, you can ask questions in the questions panel. You can drop me an email. I'm going to share it with you shortly in the chat. And most importantly, in the handouts panel, you have the official brochure of the commercial real estate investments and analysis training course with Mr. Partick Mahdi O'Neill. So I can see the number is getting higher as we speak. So let me move on. We're scheduled to have this training on the 21st of June. And let this be like an introductory. Let this be like an introductory to the training of what you're going to listen to, what you're going to learn. And if you want to hear the extended version of this topic, I will be happy to accommodate you and to welcome you on the 21st of June. So after the presentation of Mr. Partick, we're going to have a Q&A session where you can ask all your questions that you're interested about, and Mr. Partick and I will try to answer all of them. So without further ado, I welcome Mr. Partick Mahdi O'Neill to take over. Hello, Partick, can you hear me?
Hello, yes, I can hear you, yeah.
But we cannot see you. Oh, right now we can see you.
Yeah.
Okay, I think we're ready. I think we can start.
Okay, so
the floor is yours.
So everybody can hear me now, Nicola, yes?
Yes, I can hear you. I think everything is in order.
Okay, great. So I can start the presentation.
Okay. That's all from me. If you need anything, I'm here.
Okay, that's great. Thanks very much, Nicola.
No problem.
I'd like to welcome everyone to the webinar on Open Your Investment Horizons on commercial real estate investment analysis. Greetings from Ireland. So, you know, good morning, good afternoon, good evening to everyone wherever you are located in the world. I've been told many people are from Saudi Arabia, so assalamu alaikum, and hope everybody who is fasting is having a good fast. Inshallah, we'll be looking forward to Eid very, very soon. So in terms of what we're going to cover in our seminar today, just bear with me one moment. I'm just trying to move the slides on. Okay. So what we're going to cover, that for some reason that was a bit slow. So what we're going to cover today in the agenda is to start off with some introduction on commercial real estate, and look at some of the key economic concepts underlying investment in general, okay, and specifically that applies to commercial real estate. Then we'll take a look at how to solve some real estate financial problems. There's lots of different ways in which this can be done. You can use formulas, you can use time value of money calculators, and Excel spreadsheets. So we'll look at the first two. Obviously, in a training course, we run through a lot of this in great detail, all the different options, including spreadsheets as well. Then we'll take a very brief look at international real estate. So investing in real estate from an international perspective. What are the the pros and cons? What are the things to watch for? And finally, I'll mention very briefly the course that inshallah will be running, God willing, that we'll be running in June, exactly a month from now, and give you an overview of the content of what's going to be included in that. So if we first of all look at some of the key economic concepts that underline commercial real estate, and we look at when we talk about commercial real estate, what are we actually referring to? So if we look at real estate broadly, okay, it covers residential, commercial, industrial, and land. So real estate itself is a very, very broad area. So in terms of commercial specifically, what covers shopping malls, hotels, offices, apartment buildings. By the way, the definition of commercial real estate, it can change from one region to another. So for example, in some regions, if you say commercial real estate, they think you're mainly talking about offices. Most people have got some familiarity with residential, okay, either in terms of investing, okay, or in terms of having to to rent someplace. A lot of the concepts that we're talking about in respect to commercial real estate, they're applicable to real estate in general, and they're applicable to investment in general as well. So we just look at a few interesting stats first of all. Okay, this gives you an idea of the size, okay, of the commercial real estate market. So we compare it to the other asset classes. So we've got a bond market, which is 100 trillion in size. The equity market, which is actually smaller than the bond. Okay, so there's always a lot more excitement over the equity market. The bond market seems boring in comparison, but the bond market is actually bigger. So the equity market is approximately 70 trillion in size. But you can see the real estate market, both the bond and equity market, so over 200 trillion. Okay, the largest amount of this real estate is on the residential side. Then we got commercial real estate, which is approximately 28 trillion. And then we've got some gold as well, which is around the 6 trillion mark. So this just gives you an idea of the size of the commercial real estate market relative to other parts of the capital market. Real estate assets comprise nearly 60% of the value of all global assets, so it is a major sector. 3/4 of that is residential, 13% commercial, 12% agricultural, and 1% of global real estate assets trade each year in big ticket deals. So that's over 2 trillion, okay, of commercial property changing hands every year. Before we go into the detail, okay, and we look at the economics and investments principles that apply to commercial real estate, I just want to talk about things in general first of all. Okay, so just have a look at a reminder that underlying the markets is economics. Okay, and this is probably something that you'll all hopefully be familiar with from your your high school or your studies. Okay, this is a demand curve. So very simply, this says, okay, as the price of things decrease, people will demand more, they'll buy more. Okay, so if the price of cars come down, if the price of iPhones go down, people will buy more. so this is one part of the market, okay, on the buy side. Then on the other side of the market, you've got the supply or the sellers, okay. They want the opposite of buyers, okay. So if you're a firm selling stuff, you want to get as much price as you can get. So where both of these meet, where supply, okay, and demand, you get equilibrium. Okay, you get equilibrium in the markets. So at this price level, okay, this price level matches both the supply and the demand to each other. If, for example, the price is up here, okay, if the price is up here, then there's going to be excessive supply, okay, over quantity demanded. So in order to shift that, prices will need to be reduced to bring them both in line with each other. And this is very okay. So for example, we take a simple example of an industry, let's say hotels or airlines, which are obviously very topical at the moment with, you know, obviously what's happening in the current environment with COVID-19. When it's low season, okay, for example, in Dubai or in the Middle East, hotels reduce their prices significantly, okay, in order to increase the quantity sold. So for the moment, let's forget about commercial real estate at the moment, and let's just talk about investments in general, okay? So when somebody is making an investment, what are the key factors that they look at? So we look at it like a little timeline first. So T0 stands for when somebody buys the investment. Okay, so it's the beginning of the time of that investment, and TE is the end. Okay, so when the investment is sold. So invariably, when you're making any type of investment, really, you know, the first thing you're going to think about is the purchase price. Okay, this is the first thing you're going to look at. You're comparing one investment to another. You're buying a property, you're out in the market looking at buying properties, you're buying shares. Invariably, you're going to be comparing the purchase price from one investment to another. So this is going to be your outlay. The purchase price is extremely important because really that's the only thing that you control, okay? Because once you've made the purchase, okay, the future selling price, that will be dictated by the market in the future. You won't be able to control the selling price in the future. That will be subject to the market. So when we're looking at an investment, okay, we'll be looking at what's the cost that we're going to pay, and we'll want to know what's going to be the future cash flows from that investment. So between when I have bought the investment and between I sell it, what is going to be the income from the investment? So for example, if it's a bond, we're going to be talking about interest. If it's shares, we're going to talk about dividends. If property, we're going to be talking about rental income. The other key factor that we're going to be looking at is risk. Okay, what is going to be the risk to my future cash flows? So this is going to have a major determinant, okay, on what is going to be my required rate of return. My required rate of return is the rate of return that I require on the money that I'm investing now to make the investment worthwhile. So something where the risk level is higher, I'm going to require a higher level of return. So for example, just take a very, very simple example. If somebody is buying US Treasury bonds, okay, the level of interest, the level of return is negligible, very, very, very small, and that's because the risk is very, very, very low. Somebody who is invested in stocks and shares in emerging markets, the uncertainty over the future income and the selling price is much, much greater. The risk level is a lot higher. Somebody will require a higher rate of return. The selling price, what determines the future selling price? Well, it's what we already looked at in the previous screen. It's going to be the interaction of the demand and supply for that investment in the future. That's what's going to determine the future selling price or terminal value of the investment when I'm going to sell it. So if we want to try and make some sort of projection, okay, we're comparing, let's say, one investment to another. We're comparing, is this investment worthwhile? We have to try and make some type of projection as to what's going to be the future value of that investment, what's going to be the selling price when I look to liquidate that. And that will, so in order to predict that, we need to look at, predict the supply and demand for that investment, for that asset in the future. So what are the factors that you need to look at that are going to affect the future supply and demand? Okay, well, all the normal things that you would expect. The economy, okay, how well is the economy is doing? If the economy is doing well, employment is high, incomes are good, the people will be demanding more products. That will drive up the value of companies, properties, etc. Hugely important is central bank or the monetary policy that's pursued in a country. Out of all of these factors here, okay, really the factor which is of prime importance are interest rates. Okay, why are interest rates so important? Well, when you set the interest rate, you're basically setting the price of money. And when you're setting the price of money, you're effectively affecting the value of everything else. So this is why when the Fed meets, okay, or the various central banks meet of countries, everybody's waiting with bated breath to see what is going to happen to interest rates. Inflation is going to affect future price levels. If you're investing in assets in a currency other than your home country, then of course the future foreign exchange rate, and of course all these factors are related to each other. What's going to be government or fiscal policy in the future, and indeed when you're selling this in the future, what will be people's future expectations, okay? And also you have to take account for the unexpected, okay? What are the things which don't normally happen, okay, what can happen, which can have a major, okay, and perhaps unprecedented impact on what the future price of that investment is going to be. So, for example, the unexpected could include things like war, okay, leading to political instability, oil crisis, you know, major things like a recession, you know, financial crises, and of course what we have at the moment, which we're experiencing at the moment, which is a major health crisis, which has completely, okay, has just had a major impact on the economic landscape. So the health crisis has immediately become an economic crisis. And if it's extended for, you know, if this goes on for any extended period of time, it could morph into a financial crisis. So these are all going to be the future factors that affect the future supply and demand and determine the future selling price. And of course, the price that you're paying now for your investment is also affected, of course, by the supply and demand for those assets, okay, which again are obviously affected by all of these factors as well, okay, except you can take out the unexpected, okay, because obviously the unexpected is about the future, okay, so we know what the present is. Are there any other factors to take into account when looking at making investment? Yes, there's the other usual factors to take into account that would affect investors' choice of investments. Obviously, key one is attitude towards risk. So, for example, somebody who's very risk averse, they'll be more to buy bonds, okay, government bonds, or sukuk, which are Islamic bonds. What is people's capacity? What is their time horizon? How long is somebody investing for? Is somebody investing for 2 years, 5 years, 10 years? This will also affect person's need for liquidity. Okay, how much liquidity do they need? So if somebody needs assets which are very liquid, then real estate is not going to be a good option. Okay, so this is one of the downsides, or one of the disadvantages of real estate is not a very liquid asset. Also take into account somebody's knowledge and expertise. Okay, so people are more inclined to invest in assets, okay, and investments that they are familiar with. Other factor is time. Some investments require a lot more management and time compared to others. Okay, so for example, investing in a bond portfolio compared to investing in a real estate portfolio. Investing in a real estate portfolio is a lot more complicated. There's a lot more to take into account. Real estate assets, there's a lot involved in terms of ongoing management of the property, etc. So a real estate investment will be a lot more time consuming compared to, for example, a bond portfolio. Capital constraint, how much money do you have available to invest? If you have a very small amount to invest, then real estate requires large amounts of money to invest. So this will also determine what you can invest in. Tax position, okay, tax position. Again, if we come back up to here, okay, some investors, they pay a high rate of income tax. So they prefer investments which is more focused on giving a capital gain rather than an income. Okay, some investors invest for income. Okay, income is a very important component of the return of overall investments. So with any investment that we're making, these are the things which an investor will look at, regardless of whether they're investing in bonds, okay, the stock market, individual companies, or real estate assets. So now specifically looking at commercial property now, honing in on the commercial property asset class. So when we're talking about commercial property, we need to think of it in terms of two markets. So we've got a space market. Okay, so this is effectively the rental property market. Okay, so landlords that are looking for tenants and tenants that are looking to use a property. And then we've got the asset market. And the asset market is for the ownership of properties, so buyers and sellers of property assets. And of course, both of these assets are interconnected. We'll look at that interconnectedness in a moment. So the space market is made up of property owners, landlords, and property owners, tenants. So the interaction between the supply and the demand will determine both the occupancy level, okay, and the rents that are achieved, okay. So it'll determine both the occupancy level and the rents that are achieved. So for example, if we have excess supply, okay, what's going to happen to rents? Rents are going to come down, okay. If we have much greater demand, okay, there's a shortage of property, then that's going to push prices. That's going to push prices up. If we look at this is here, we're looking at an example of a demand curve, okay, for property. This is based on, let's say, this is office space, and this is based the current one in the middle is the current demand based on 30,000 workers using the office space. So what happens, okay, if the number of workers increase, so let's say an area is doing well. So companies are moving to they're setting up operations, etc. So employment is increasing. So this is going to cause a shift up in the demand curve, okay, which is going to push prices up. And vice versa, if an area is in decline, it will cause a shift down in the demand curve. If we look at things now from a supply perspective, so the demand curve looks like the normal demand curve that we looked at the beginning. Now the supply curve, this looks completely different. This does not look like the normal supply curve that we're used to seeing in economics. So why do we have the supply curve here? This is because we're looking at the supply curve in the short-term horizon, okay? So in the short term, the supply, let's say, for example, if we're talking about offices, the supply of offices is fixed in the short term. You know, it takes a while to build, okay? It's not like we can increase the machines producing, widgets, okay? It might take 1-2 years to bring new supply into the market. So this basically means that in the short term, okay, the supply is fixed. Then over the long term, what happens to the supply, okay, will depend on the long run marginal cost. So with a rising long run marginal cost, that means the prices are going up, the supply will increase, okay, and this is basically where we see the normal supply curve, okay, prices increasing, therefore the suppliers or the developers will increase the supply of property in the market. And the opposite, if prices are falling, then over time, gradually supply will reduce. Again, it takes a while to reduce supply. Okay, so for example, buildings that are no longer being used as offices, being converted to something else, being demolished, etc. So that takes a while. It does not happen straight away. So in the short term, supply of real estate is quite a sticky asset. If we're making an investment, we need to forecast what are going to be the future rents. So we need to look at what's going to be both the future demand and the future supply. And this is really where a lot of people make mistakes in investing in the real estate market, okay? So for example, often they just look at the demand side. They say, oh, okay, well, demand is good, okay? But we need to look at the future supply as well. Okay, what are the number of units that are going to be delivered in the next 12 months? Okay, how much new projects are going to be starting? Okay, because the price is going to be determined by both future demand and future supply. For investors, the worst case scenario, which does happen, and happens even quite often, is where demand reduces, okay, and supply increases. This will really crunch prices down. Now we look at the asset market. So the asset market is in those investors that want to sell and those that want to buy. This basically determines property prices, or what we call the capitalization rate. We'll come to the capitalization rate in a moment. So the interaction between investors wanting to sell and those wanting to buy will determine what the prices of those properties are going to get in the market. The thing to remember from an investment perspective, okay, when somebody invests in real estate, they're investing for future cash flows, okay? This is the same reason for investing in bonds, the same reason for investing in commodities, the same reason for investing in shares, etc. It's to derive future benefit, to derive future cash flows. So when investing in commercial real estate assets are competing with all other assets in the marketplace as well. Okay, so real estate is just one part of the four major asset classes. Between private market and public markets. So in a private market, we're talking about real property. Okay, so units of property changing hands. In the public markets, so REITs, for example, okay, real estate investment trusts, okay, other types of investment vehicles that are investing in real estate, okay. So they're buying real estate properties, and effectively it's a unitized investment. So, for example, somebody didn't have a lot of money to invest. They want to get exposure to real estate, but they can't afford to buy directly. Then they can buy via a fund. Another advantage buying via fund is diversification as well. So that's one of the disadvantages of real estate. It requires a lot of money to invest, and it's difficult to achieve diversification unless you've got a large amount of money. Now we look specifically of the pricing of real estate assets. So as like the pricing of any asset is going to be affected by supply and demand. Individual properties are going to be affected by the perception of potential investors regarding the level and riskiness of future cash flows. So take a very simple example. let's say you have a commercial park, business park. You have two buildings which are sitting, side by side. Okay, they're both built the same year. They're both identical in every respect. One building is let out to a government body, and the other building is being let out to a startup IT company. Okay, so which building is going to be more valuable? So even though physically they're the same, okay, physically they're the same, there's no difference between both buildings. Obviously, the risk to the future cash flows with the government tenant is going to be a lot less compared to the other one. So in that scenario, the government building will be more valuable. To allow comparisons, it's useful to think of property value per dollar of current net rental income, current net rent or income. So we'll be looking at the capitalization rate. So what is the capitalization rate? So an easy way to think of it is like is the yield, okay, on investment. So for example, if we're talking about bonds, we'd be talking about the running yield, which is basically the coupon divided by the market price of that bond. If we're talking about shares, we'll be talking about dividends. Okay, so what is the dividends? What is the dividend yield? So the income which is distributed. So the capitalization rate is effectively looking at what is known as the net operating income. Okay, so the net income from the rental income of the property as a percentage of the value of the investment. So the cap rate is the net operating income as a percentage of the property price or value. So this is very useful because it allows us very easy to make a comparison from one commercial property to another. And it allows us to make comparisons. Okay, so which one, which one has got a higher cap rate than the other, why is that, etc. When we're looking at making investments, we can look at the cap rates of similar commercial properties to see what we're being quoted or what's being offered, whether it is good value or not. If we change this formula around, okay, we can approximate, okay, or we can estimate what should be the value or price of a property by the net operating income divided by the cap rate. Okay, so this is a way of estimating the value of a property. So we look at what determines cap rates. So this is effectively, when we say cap rates, we're saying basically what determines the value of the property. And what we're talking about here can apply to any investment. So the first one is the opportunity cost of capital. What is the opportunity cost of capital? The opportunity cost of capital is basically the return that you could get from investing the money elsewhere. This will also be affected by what are the interest rates. Growth expectations, okay, in the property's future cash flows. So for example, if you're in an area which is growing in prosperity, you know that future supply coming into the marketplace is quite, it's quite limited. Then you know that you can increase your lease payments in the future. This means that you'll be willing to take less in the short term. Risk, this is obviously key. The risk to the future cash flows. This is obviously particularly important at the moment. We look at the current situation, which is, in the last couple of months, which is completely transformed. Around the world globally, economies have been shut down. Businesses have been shut. So now you have huge problem, huge potential problems with this lack of economic activity. Businesses not being able to do business, they're not having the income to pay their lease payments, etc. So the level of risk now to cash flows, to future cash flows, is much, much greater now compared to what it was a couple of months ago. What does this mean? Okay, this basically means that prices will go down. Okay, prices of commercial real property will have to go down to compensate for the greater level of risk. If we look in the public market for real estate, so in the UK, I run FCA regulated business, financial advisory business, and you know, all the commercial property funds, right nearly from the beginning of the crisis, they have basically stopped trading in the funds. So this means that existing investors cannot sell out, new investors cannot buy in. And I would expect, okay, that when things do go back to normal or the new normal, the prices of these funds will be marked down. This is exactly what happened in the financial crisis and the credit crisis in 2008. All the funds, they basically stopped trading, they shut up shop, and then when eventually they did open again, the prices were marked down significantly. So we can expect to see similar in this market as well. And of course, obviously, huge amount of uncertainty. We don't know when there's going to be a vaccine, effective treatment. Is it going to come back again stronger? Are we going to get second waves? So we have huge uncertainty in the market at the moment. So just to check that, you know, everybody understands the idea of cap rate. If we just consider some examples here, okay. So let's say an apartment building in a declining neighborhood, or an apartment building in a growing neighborhood, which should have a higher cap rate. So think about this in terms of which should have the higher yield. Okay. Second one. Okay, an office building full of long-term tenants, an office building full of short-term tenants. Okay. Which should have the higher yield or the higher cap rate? Okay, so I'll let you think about that for 2 seconds before giving you the answer. So with the first one is going to be A. Okay, an apartment building in a declining neighborhood. Okay, in the second example is going to be an office building full of short-term tenants. Okay, long-term, there's less risk to the cash flow. Okay. So therefore, for short-term tenants, and where there's also there's more risk to the cash flow, there's more management involved, you're going to have a higher return. A good example of this, if we compare let's just talk about residential property for a moment. If we compare long-term residential lettings to short-term holiday lettings or Airbnb, the return from Airbnb is generally a lot higher compared to what you get on long term. And this is why we hear, you know, all the time, you know, cities having problems with Airbnb because too many people are putting their properties on Airbnb to do short term because it's giving them a higher yield. Okay. With that higher yield becomes a higher risk. Okay. There's a time, with COVID-19, it's pretty much overnight shut down this market completely in most cities in the world. If we look at some more examples, okay, real estate when bond yields are 6% or 8%, okay, a surface parking lot in a thriving downtown or a 10-story parking garage in a thriving downtown. Office building with short-term below market leases, okay, or office building with short-term above market leases in a declining rental market, okay. So again, okay, when bond yields are 8%, the yield from, okay, commercial real estate is going to have to be greater compared to when the yield is 6%. Okay, quick question to ask. If interest rates go up, okay, if interest rates go up, what impact will that have, all other things being equal, on commercial real property prices? Okay, so ask yourself this question, okay, will prices go up or will they go down? Okay, so prices will go down, okay. So interest rates going up will have a negative impact, okay, on the price of investments in general. Okay, so often you'll have heard that if interest rates go up, bond prices go down. So here, going back to the example of bonds, okay, being higher, okay, then commercial real estate will have to match those yields, okay. So in order to match those yields, okay, the price of commercial real estate will have to fall. So this is similar to bonds, okay. When interest rates go up, as you know, day follows night, the bond prices will have to go down. The point we're making here is, you know, financial capital is mobile. Okay, money can move easily, okay, from one asset to another, from one geographical location to another, from one region to another. The real estate market is not segmented like the space market. What do we mean by that? So we mean that money can move around irrespective. So money is just looking for the best risk-adjusted returns. Whereas property, okay, the space market is segmented. We can't, we can't move a property. Okay, we can't move a property from one location to another. We can't change the use of a property. Most of the time, we can't change the use of a property from one to another. We can't change a warehouse to an office, or office to a warehouse, and so on. So the space market, okay, is highly segmented, but the capital market, the asset market, is not. If we now look at the interaction of the different markets of real estate with each other, so remember we spoke about a space market already, which is made up between the landlords and the tenants, which determines the rent and occupancy. Then you've got the asset market, okay, which is made up of owners selling and investors buying, okay. So when investors are buying, okay, what's one of the key criteria that they're going to look at? Okay, they're going to be looking at what are the rents, okay, what is going to be the cash flow, okay, especially when we're commercial real estate, okay. Commercial real estate, the value of commercial real estate is very sensitive to the cash flow, to the income, to the expected cash flow from that real estate. The cap rate, remember, this also takes into account the risk of these future cash flows as well. Then the prices here, we also have the development industry, okay. So if prices here are high, okay, which means that development is going to be profitable, this is going to increase supply. So developers will increase the supply. They will build new. And often the problem, it can take a couple of years. Okay, so things are looking good. Okay, so too many developers jump on the bandwagon. They build like mad. Okay, and then by the time the supply is ready to come into the marketplace, now the space market is depressed. So this is why often you get a lot of either oversupply or undersupply of market, and this can have a huge effect on prices. And then, of course, demand is going to buy, like, you know, factors we've already mentioned, you know, what's happening, etc. So, for example, in the current environment now, we'll see a huge negative impact on demand, okay, which is obviously going to affect both occupancy and rents that are achieved. Then we have other factors. Just some of my screen is hidden. It will be capital markets. Okay, so what's happening in other asset classes? What's happening in the capital markets? What's happening with interest rates? This will also have a huge effect on the asset market. Okay, so now we're going to look at move on to solving some real estate financial problems. So real estate is also involving cash flows in different periods of time. So, for example, buying a property now, selling it later. That obviously applies to any type of investment. Sign a lease now, pay rents monthly over time. take out a mortgage now, pay it back over time, buy land now for development, pay for construction, and sell the building later. So when we're talking about real estate mathematics, we're talking about present value mathematics. This is being able to relate cash amounts across different periods of time. This, of course, applies to other investments as well. So you need to be good at doing present value mathematics. As I mentioned at the beginning, there's a few different ways in which this can be done. We can look at formulas, we can use Excel spreadsheets, we can use time value of money calculations. So first, formulas, okay, this is the basic formula, okay, so this is looking at a single sum, okay. So PV is present value, FV is future value, or refers to the required rate of return, and N is the number of years or the period of time. These are other derivations of that formula. So sometimes you have the present value, but you want to find out the future value. Sometimes you've got a future value and you need to get the present value. This is to calculate the required rate of return, and this is to require the period of time. So you get the natural log. So anyway, I'm not going to dwell on these formulas. I cover these in great detail in the course. So we take a look at a simple example. Okay, so in this scenario, you see a property which you think is going to be worth $1 million in 5 years' time. Okay, so 5 years is the time in which you want to sell it. However, you might be wrong. Maybe instead of being worth 1 million, things might not be so good in 5 years' time. It's difficult to predict the future. The longer the period of time is in terms of the future, the more difficult it gets to predict. Your required rate of return is 15%. Okay, so the required rate of return is 15%. So that's basically made up of for example, your cost of capital. Okay, your cost of capital, the amount of risk that you're taking with the investment as well. So we look at how we work that out. Okay. So we have to do two calculations. So if it's going to be worth 1 million, okay, we discount that by 15% over 5 years. Okay, so basically what that means is if I can buy that asset today for 497,000, okay, and assuming I can sell it for 1 million in 5 years' time, I will get my required rate of return. But I want to be on the safe side. Okay, I want to be on the safe side, and being investors, you need to be on the safe side. If it's only going to be worth 900,000 in the future, that means I can only afford to pay 447,000 for it, which is nearly 50,000 less. So if I can get it for 447, okay, this would be a good price. 447, and it does end up for selling for 1 million in 5 years' time. That means I will get more than a 15% return. So we look at another example. Back to more formulas. This is the same formula that we looked at before, but this is where the compounding is happening greater than annual. Okay, so compounding on a monthly basis, on a quarterly basis, etc. So these are the formulas. Again, I won't dwell on these formulas. It's just to give you a very quick idea of the formulas that are used for making these calculations. If we look again at an example, just to clarify here, or here is the required rate of return. So when the compounding period is greater than annual, okay, we divide it by the number of compounding periods, and the number of years we multiply by the number of compounding periods. We'll look at an example now, and this will become more clear. So we look at this example. what is the present value of a 20-year lease, okay, which has got rental payments of 1,000 each due at the beginning of each month, where 12% is the appropriate cost of capital. So 12%, that is required cost of capital. So how do we work this out? So we want to know, so we got this lease is going to give us 1,000 every month for 20 years, okay? So we need to know in today's terms, in today's money, how much is that going to be worth for us? Okay, so if we look at it, okay, so we would have to, so that's going to be 1,000 every month, okay, for 240 months, okay. So we're going to work it out. We didn't have to discount each rental payment by the appropriate amount. So you can see here, okay, 12% is the required rate of return. So on a monthly basis, that's 1%, 12% divided by 12. That gives, that's where the or here is coming from, 1.01, and this is the rental income. But obviously, to do all these calculations is going to take you a very, very long time. Okay, that's like 239 calculations. You'll be there for doing it for a long time. This represents a geometric series, okay, which in simple terms means that there's a formula that we can use, okay, which is here to work this out very simply. So when we use this formula, then we get this answer. But is there another way that we can work it out? So this is using a formula. So I'm just going to switch over to another method to show you very briefly. I'm going to show you the 10BI calculator. So this is a time value of money calculator. This is a very, very useful instrument. I've got it on my laptop and I also have it on my mobile phone as well. So you can get it as an app, the 10BI financial calculator. It's not a free app, but it costs like about, you know, $5 is very, very useful. So I'm just going to show you some simple examples with this and show how to work out some of these solutions using the 10BI financial calculator. Now you can see here I've got a lot of stuff up here, so I want to clear all of this first. So I'm going to press Shift key, which is here, Shift, the LEO button, and this cancels all. Okay, so this all takes it back to 0. When we're looking at the payments per year, it's currently set on 12. Okay, it's fine because it's going to be 12 payments per year because we're talking about monthly lease payments. If we look at the terms up here, N, the ones which we're most concerned with are here on the top row. Okay, so we have PV, which stands for future value. FV is the, so here, present value, future value. Here is the interest or the growth per year. N is the period of time, and PMT is the for regular payments. So this calculator is very it is very versatile. Okay, it's very versatile. If we take a very simple example, okay, we'll take a very simple example first to show how to use this. So first of all, I'm going to shift this payments per year to 1. So press Shift. Here you see P per year, payments per year. So I need to put in the 1 first. So put in the 1, Shift, payments per year. So now it's on payments per year mode. So we take a very simple example just to show how this is used. So let's say somebody has got 10,000 to invest, $10,000, 10,000 dirham, euros, whatever it might be. So the person is investing this, okay? So this cash flow is going to be leaving them, so we need to make it negative. And we put this as the present value, okay? So this is how much somebody is actually investing. Let's say they're doing it for just 1 year, okay? So N is 1. Let's say the interest rate or the growth rate is 10%. So we put that in as a growth rate. So what's going to be the future value? Okay, is going to be 11,000. So this is very easy. Okay, so you can see the interest rate is 10%. 10% of 10,000 in 1 year is 1,000. At the end of 1 year, the future value is going to be 11,000. If I said, for example, okay, I'm going to invest for a period of 10 years, so I can change N to 10. Okay, so now we have 10 years in here. Okay, now I can recalculate the future value. That shows that if I do it for 10 years, at 10% growth per year is going to be worth nearly 26,000. Let's say that I can also save, as well as doing a lump sum. Okay, I want to put some money in on a regular basis as well. So let's say I'm going to put 1,000 per month. So 1,000. Again, I'm saving the money, so we'll make that negative. Okay, so I'm going to put that under PMT, okay, which is the regular payments. Now I'm going to be putting this in on a monthly basis, okay, for 10 years. This is currently on payments per year of 1, so we need to change this to, so I'll put in 12, 1, 2, shift, payments per year. So now you can see that my payments per year are 12, okay. Now I calculate the future value, okay. I have made a mistake here. Can anybody spot a mistake? Okay, so basically I changed the periods per year for 12, okay, but I didn't change N, okay. So N now has got to be 120, okay. So I can either put in, simply write 120 and change it here, or I can put in 12 and I can do shift payments per year, and it will do that automatically. Okay, automatically. Okay. So this is over a 12-year period. Okay, 12 12s. Okay. I want to do it over a 10-year period. Shift 10 shift payments per year. Okay. Over a 10-year period. Now we calculate the future value. Okay, this basically shows, and this is over a longer period of time. This is over a 12. This is over 100 years. Sorry, we want to do 10 years shift. Okay, now we recalculated future value, so will be 233,000 odd. So in summary, what we got here, this basically somebody's making an investment of 10,000 today, and they're investing 1,000 every month for 10 years. Okay, the future value of that in 10 years' time is going to be is $233,622 dollars. If I want to say, well, the 10% is too optimistic, I want to change that to, let's say, for example, 6%. I simply change the growth rate to 6, and obviously recalculate the future value, which is then going to be a lot lower. So this is very, very versatile. So to come back to the problem here, so let's clear all of this. So we do shift cancel all. So this takes us back now to clear screen. So if we take a look at the example here, we want to know the regular payments is going to be 1,000. 1,000, okay, is going to be the regular payments that we're going to receive. The period of time is 20 years. So we have already payments per year as 12. Okay, so we say 20 shift is the payments per year. So now N is 240, so 2 periods of 240. Our required rate of return is 12%. Okay, so we put 1, 2. That's our required rate of return. Okay, and we want to know what is the present value of that, okay? So we calculate the present value and we get 91,727, which is the same answer that we get here as per the formula. So basically, based on a required rate of return, the value of that lease, okay, for me today is $91,727. That's how much I would be prepared to pay. If the person who is selling the lease to me, if they're looking for 100,000, that's going to be too high. Okay, that will not meet my required rate of return. If I said, okay, well maybe, okay, I'm willing to do 100,000. Okay, so let's say 100,000. Okay, so we'll make that negative. So that's how much I'm prepared to pay. Then how much is my yield going to be? Okay, my yield now is only going to be 10.66%. So if I pay 100,000 for the asset, my yield is only going to be 10.66%, which is less than my required return. Okay, so we'll go back now to the presentation. And what I'm going to do, there's another example here, which I'm just going to skip that as I'm sort of looking at the time and conscious that we might be running out of time soon enough. So just so that I'll cover some other areas. Okay, so one of the key things that we're looking at, let me just go back to presentation mode. Bear with me one moment. Okay. So going back, one of the key things we're looking at is discounting cash flows. Okay, discounting cash flows and determining what are the net present values. So discounting cash flows, you first expect for the property, ascertain what is the total required return. Okay, so for example, now these days, okay, because of the third factor, okay, risk going up, required returns are going to be increasing. Then we discount the cash flows to the present value based on the required rate of return. This basically tells what an investor is willing to pay today for those future cash flows. For the discounted cash flow. So exactly like the examples that we just looked at. As I said, in reality, okay, you're not going to be writing down these on paper to work it out. You're going to be using time value of money calculator or Excel spreadsheets to make these calculations. And I'll cover all of this in great detail in the course and run through many numerous examples. Here's like an example of one, okay, where the cash flow is different, okay, where the cash flow is different. So it starts off at 1,000, and then 2004, 2005, 2006, it increases, okay. So the formula that we looked at previously, we can't use that because the cash flow amount is changing, okay. For the time value of money calculator, okay, we can use that, okay, but we use slightly different functions. Now, I'm not going to work through the whole thing, but just to show you very briefly what I'm talking about. So just here, clear all of this, okay. So here it only works, okay. Here, this cash flow is going to be the same, but we're seeing in this example the cash flow is different, okay. It's a step up lease. So when the cash flows are different, we now move to this function, cash flow, okay. So in this cash flow, and I'm not going to run through this whole example, I just want to do very briefly. Here you put in the initial cash flow, which is usually going to be a negative amount, and then you add in the cash flows, okay. So for example here, add here. I can add in as many cash flows that I want, and then I can calculate the net present value, etc. Okay. So due to our time constraints for this webinar, I won't run through this particular example, okay, but I run through this extensively in the course. Okay, so back to the presentation. So we've run through that already. There's the answer for that particular one. And by the way, I believe everybody would be getting a copy of this webinar. These examples, you can look at them, you can try and calculate them yourselves, you can get the TINBII calculator and use it, to do these calculations. They're easy to do them on Excel spreadsheets as well, but again, on time constraints, I won't be running through Excel with you in this webinar. Common mistakes that are made when doing this discounted cash flow is in terms of the assumptions, okay? So being over optimistic on what the future rent increases are going to be. Okay, so sort of like saying, oh yeah, doesn't rent increase with inflation, for example. So the person who is selling the commercial property, they will try to be as optimistic as possible on the assumptions that they're going to make on future increases to the rental income, which of course affects the future terminal value as well. Another thing which often people don't take account of, and this happens both on the residential and the commercial, okay, is the expenditure of capital improvements in the future. So capital improvements. So this is why, for example, with older properties, all things being equal, with older properties, we will require a higher yield or capitalization rate on older properties compared to newer properties, because we know we're going to have to spend more money on capital improvements to those properties compared to a new property. Other common mistake is the expected return is going to be too high. Okay, so sometimes, okay, one needs to make one is over optimistic or over ambitious in terms of what required returns should be. The reality is as well, one also needs to compare, taking action compared to not taking action. So sometimes sometimes you might not be getting the ideal rate of return that you would like, but some return is better than the money sitting and not doing anything. The opportunity cost of not doing anything with your money. Now we're coming up towards the last section. We're going to talk very, very briefly about international real estate investment. So when you think about it, when it comes to real estate investment, it tends to be very localized. Okay, if we consider residential property investment, most people, when they're doing it, they do it very, very local to them. When I invested in real estate myself in the past, the first residential property that I bought, I was in a flat. I bought the flat which was below me, so that's as close as you can get. And why did I buy it? I didn't back then, which is more than 20 years ago. I certainly didn't do any complicated analysis. I didn't do any discount cash flow analysis. I bought it because the flat was below me, so very, very easy to manage and keep an eye on it. Cross-border capital flows, they've increased. We're living in a very, very global market. Capital moves across borders very, very quickly. Obviously, we'll see what impact COVID-19 has on the long-term impact. All of a sudden, this has gone into violent reverse globalization. So international companies, obviously operating across the globe, so they have a need for real estate across the globe, setting offices and headquarters around the world, increasing globalization, which we've mentioned already. So one of the great things about investing internationally is the potential for greater diversification. Okay, So things in your home economy might not be so good, but you can say, okay, well, let's invest in a market where the economy is going well. The market factors are much more favorable towards investment. Different countries going through different phases of the economic cycle. You can achieve a better, a more efficient risk frontier. What do we mean by that? If we take a look at this example, so this here shows the maximum, this line here, curve, shows the maximum efficiency between risk and return. So we're talking about a domestic portfolio. This is where you're maximizing the expected return for a given level of risk. But by investing internationally, we can make this curve, we can shift it out to the left. So in simple terms, if we take, for example, if we only invest domestically, this is our portfolio here, A, okay, giving this level amount of risk and this level of expected return. But by investing internationally, okay, and opening up, okay, the assets that I can invest in internationally, making the market broader, this adds efficiencies. So for the same risk, I can get a higher expected return, okay, or, okay, portfolio B, reduce the level of risk, okay. So in theory, international investing makes a lot of sense. And we'll find this if we're talking about, for example, bonds, stocks and shares, etc. The same principles operate. But for real estate, it's a bit more tricky. It's a bit more difficult. Okay. First of all, to take into account, property transaction costs can be very high, and it can vary a lot from one country to another. Okay. Following this slide, we'll see a table. So investing abroad will require fantastic timing or long-term commitment to recoup these costs. This is the other thing with commercial real estate investing. You need to have a long-term horizon. Okay, so most will look at it over a 10-year period. Okay, whereas investing in bonds, stocks, and shares, you can have a much shorter-term horizon. Information costs are higher. Okay, so what do we mean by that? Okay. So, for example, if let's say, for example, if I spend international equity, it's relatively easy for me to do that compared to investing in real estate, which is thousands and thousands of miles away. Okay, I don't know about the local market, so it takes a lot of time. Okay, to bring one's level of knowledge up to the level of local expertise. If you don't do that, then the risk is that you're going to be paying too much for real estate that you're buying, and indeed other risks as well. You know, political stability, foreign exchange risk, and so on. This is an example, okay, of the various costs, okay, of investing in real estate in various countries. Okay. So you might have some type of tax to pay, okay, like VAT, stamp duty, okay, you have agents fees or commission, then you've got legal fees, okay. So investing internationally in real estate is a fairly complex business, okay. A lot of information and different circumstances to take into account. So while in theory it sounds quite good, in practical terms, it can be quite difficult. So just to finish off the webinar before hopefully we take some questions. This has been basically a very brief session just to give you a small taste of the type of things which we'll be covering in the live virtual training, which is going to be taking a month from now. In the course that we run for 5 days, okay, or sorry, actually 4 days, it's an intensive course. Okay, it really is an intensive course. As a trainer, I would call myself a sadist. Okay, so I like to inflict pain, but a good type of pain. Okay, so by the time you get to the end of the day, you feel that your brain is bursting with information and practical knowledge. So we look at we look at the theory and the practice in the real estate market. By the time you finish the course, you will just be amazed at how much there is to know about commercial real estate investment analysis. When we do the maths bit, okay, the economics bits, the investment concepts, we look at even things like our urban economics. Okay, so how do cities grow? How do you do real estate markets analysis? The economic, financial, and investment concepts that affect commercial real estate investment. We go into detail on discounted cash flows, how to calculate that. We looked at advanced micro level valuation. So this is basically where you're looking at things where not covered by discounted cash flows, okay, where some types of commercial real estates would have greater value over and above than what's reflected in the discounted cash flow analysis. We will look at things from a debt side. Okay, debt is very important. Okay, a lot of leverage is used, okay, to invest in real estate in general and commercial real estate. So we'll look at things from the perspective of the mortgage lender. Okay, what is their criteria? Okay, how do they underwrite? This information is very, very valuable, okay, for those that are then, you know, subsequently going to be looking or getting involved in negotiating mortgage finance for commercial real estate investment. We take a look at the public market for real estate and how does that affect the private market. Finally, we take a brief look then at project development, okay, the development side of the real estate. And we also take a very brief look at Islamic finance and real estate as well. So how is real estate financed using Islamic finance structures? Interest in Islamic finance interest is not allowed, okay? So we look at how Islamic finance structures are used for financing real estate investments. So that pretty much finishes up what I want to say on the webinar, on the presentation part. I'll see now in a moment what questions are there, what time we have to take some questions. I'd also like to, at this juncture, really just to thank everybody for taking the time to attend this webinar, and hopefully that you've got, you know, benefit from it. So now I'm just going to move and have a look at hopefully what questions we have got.
Yes, let's move on with the questions.
Anybody got any questions? Yeah, okay. Fine.
Yes, we have a question. What do you think about real estate within Dubai market nowadays? Is it a good time to buy, as it will be my first deal? From Mohammed Saleh.
Okay, right, okay. Yeah, this is an excellent question. I spoke. I mean, I know the Dubai market, you know, reasonably well. I'm invested in Dubai real estate market myself. I used to also live in Dubai as well. I think that anybody who's making any investment now, okay, almost in any part of the world, has got to be extremely careful. What you also have to remember as well, the real estate market, it moves more slowly if we, let's say, compare it to the stock market. So if we look at the stock market since the outbreak of this virus, the stock market has been crazy. Okay, if we look at the U.S. market, the S&P, a few days in a row was falling by 10% in value. Okay, it fell by about the S&P, which represents, you know, the biggest companies in the U.S. market, from its the beginning of the year to its low point in March, it fell like by about 25–30% in value. Okay, then a few weeks later it recovered a lot of that. It's not back to where it was at the beginning of the year, but it went up by about 20–25% in value. So the stock market, other assets, they react very, very quickly to news. So with real estate, it reacts more slowly. Okay, so for example, if you're looking now, and let's say you're getting, you're looking at you go onto a website, you're looking at commercial real estate properties or residential real estate properties, you probably still won't find that much change in the asking price compared to what it was a couple of months ago. But it's only when you start then to speak to the agent, you start actually negotiating, okay, then that you find that prices have actually prices are coming down. So anybody who wants to sell in the current marketplace, they need to be prepared, okay, to take a knock in the price. Is it a good time to buy or not? Okay, now this is the the $60,000 question, as they would say. It's very difficult to predict what's going to happen. My own opinion, okay, is that we're still at the relatively early stages, okay, of this. So the property market is now, economies are starting to open up again, people going back to work. A lot of people have lost their jobs. So it's going to take like a good 6 to 12 months for the full economic effects, okay, that have come from the virus to be felt across the real estate asset markets. So if anybody was to buy now, you need to be getting a really, really good deal. And at the moment, I get sort of good deals coming to me all the time, okay, and I look at it and I sort of say, well, I'm not in any rush, okay. There'll be plenty of good deals in the marketplace at the moment. We're going to have a supply of property in the market, more people wanting to sell rather than to buy. So I think that's an excellent question. My view is that it's still too early to jump into the market. I think there are worse times ahead of us. There are going to be better times ahead to invest in the market. At the same time, one needs a long-term view. Very famous investor Buffett, who was asked about the market early on in the crisis, he was asked, sort of, about the market, and he said when he's looking at the market, he says, I'm taking a 20-year view. Okay, where's the market going to be in 20 years' time? Okay, so one needs to take a long-term view of the market. So we're talking about buy. Okay, what's the long-term perspective of the buy? Okay, where is it going to be in 5 years from now, 10 years from now, 20 years from now? Okay, obviously, yes, the short term is going to be very, very painful. So, any other questions?
Any other questions? Yes, please don't be shy. Ask away. We're going to try to answer every single one of your questions. I know it's Thursday and you're getting, you want to relax a little bit for the weekend.
Well, probably, I think probably the problem, Nicola, I think the problem is many people are fasting. So probably
maybe, yes.
I am, just to let the audience know, I am fasting myself. Here in Ireland, we have a long time to go. Okay, it'll be around 9:30 in the evening before to break the fast.
Okay, we have a question from Hassan Patel.
Okay, what is the question?
You want me to read it? Okay. What is your outlook on the UK market, not only with COVID-19, but also Brexit, from Hassan Patel?
Okay, Hassan Patel is a beautiful question, Hassan. This is a question which I ask myself often as well. So with the UK market in particular, we've got really two major dynamics. Okay, we've got obviously COVID-19, which is affecting everywhere at the moment, but obviously it's affecting some countries more than others. And if we look at the countries which have handled, would say, the virus well or bad, it would sort of say UK has been more on the bad side than the good side. So this is number one. And number two, you mentioned Brexit. Okay, this is another major factor as well. What's going to happen? Are we going to end up getting a hard deal Brexit? In the short term, okay, prices are predicted to come down. But in the same way with the Dubai market, it's going to take some time for that to feed into the market. It's going to take 6 to 12 months, okay, to see that coming through. The other factors to bear in mind with COVID, what are governments around the world doing? Governments are borrowing money, okay, to deal with the economic crisis, okay, to try and avert economic disaster, to avert things morphing into a depression, to avert the economic crisis becoming a financial crisis. And one of the things you need to remember with the UK, okay, let's say compared to Europe, okay, or compared to the Eurozone, UK is still in charge of its own currency, it's in charge of its own monetary policy. So if we look back at the financial crisis, okay, back in 2008, okay, what did the UK do? Like similar to the US, they did quantitative easing, they did money printing. So the UK is able to let its currency take a lot of the pain, okay? So with the UK, we need to look at, for international investors, we need to look at what's likely to happen to the future exchange rate and what's likely to happen to future prices. So both of those, I would say the outlook is negative, okay? Prices are going to come down because of the health crisis, which is now an economic crisis. And also very likely, sterling could become cheaper as well, both as the government engages in quantitative easing to deal with the COVID problem, and also with the risks of Brexit as well. So i.e. if the UK government is adamant to go down the route of pursuing a Brexit, a hard deal Brexit. And at the moment, it doesn't look very optimistic at the moment. Okay, it seems there's a lot of distance between both the UK and Europe at the moment. So I would say that the current market is absolutely great to be in a position where you're sitting in cash, okay? What I've been talking to clients is my inclination is to sort of say, keep your powder dry at the moment, okay? Look at the market, okay? Look at the market. Keep an eye out on the price trends, on what's actually happening. When it comes to the real estate market, no sort of real rush to get into that at the moment. Somebody buys now, they might still be paying close enough to the market price what it was a couple of months ago, and potentially you're talking about a high risk of current sterling going down as well. To be honest, it wouldn't surprise me if we get a hard Brexit along with the effects of Brexit. Even though sterling is already historically very, very low, it wouldn't surprise me to see sterling getting even significantly lower than what it actually is now, dropping maybe another 10–15%, maybe not as extreme as that, but maybe going to parity with the US dollar, for example. Thank you for that question. Any other questions?
We have a few more.
Okay.
Yes. How the valuations would be during the COVID-19 era, from Raid Al-Kubaisi.
Okay, yeah, this is a very good question, Raid. Thank you for that question. When the process that I've outlined, okay, for the real estate valuations, commercial real estate valuations, that process, the fundamentals, the mechanics of that process will not be changed by COVID-19, okay? So we will still use the same mechanism the same rules, discounted cash flow analysis, etc. But what will change, okay, what will change is the discount rate that we use, okay. So the discount rate, will it increase or will it go down? Okay, the discount rate will increase to take into account that future cash flows, there's much greater future cash flows. So if we're using a higher discount factor, okay, what's that going to cause to valuations? It's going to cause valuations to go down. So we'll still use the same mechanism, okay, but we will valuations will go down. And as I've already outlined in the at the beginning of the webinar, commercial property funds, like in the UK market, they stopped. They said early on, we just can't do valuations at the moment. Okay, we just don't know where things. It's too difficult to do valuations. Okay, you can still do valuations, of course, but you need to apply a higher discount factor. Of course, the problem with these funds as well. Valuations is one issue, but the other major issue, which is maybe very significant issue as well, is cash flow. Commercial property funds, they might keep 10–15% of the fund in cash. So when things are bad and people are withdrawing, want to get their hands on cash, they will lose their cash very, very quickly. So to stop people taking cash out and for the fund running out of cash and being forced to sell assets at fire sale prices, they have to stop dealing in the fund. So that stops people taking cash out of the funds. But in terms of everything I've outlined here, all the the mechanics, we'll still use the same mechanics, but now we'll be applying a higher discount rate compared to before, and which will result in lower valuations. And just to give you another example, like talking here about the Irish market, commercial property market is very, very strong in Ireland. Actually, it's been a very, very good market for commercial real estate. But I'm just speaking to an agent on the real estate on the residential side. As we said, that any deals which were in the process of going through when all of this, erupted with the virus, a lot of those deals, they've either fallen through, okay, so sort of before legal completion, they've either fallen through, or they've fallen through, or the price has been negotiated, okay. So you go back to the seller and say, well, mate, look, we live in a different world now, okay. I can now only offer you 90% of, or 95% of what we originally agreed to drop prices like immediately, even for deals that have already been agreed but haven't been legally concluded. They've had to drop prices a bit in order for the deal to go through. And a lot of vendors will do that because their attitude is, well, okay, let me take a small hit now, because if I wait, it's probably going to be a much bigger hit down the line. So, any other questions?
Yes, we have quite a few actually. Next one is from
okay.
Ahmed
We might not be able to handle the. Okay.
Yes. Some of them we might not be able, but Ahmed Al-Kahtani is asking, what is online trading in real estate? Is it worthy or not? Let's just try keep the questions a little bit shorter, because I think we're gonna run out of time. Okay.
Sorry, Nicola, could you repeat the question again, please, Nicola?
Yes. What is online trading in real estate? Is it worthy or not?
Oh, is it worthy or not? Okay. Yeah. Okay. Yeah. I think there's this is an interesting question. Okay. Look, the reality, the reality is, okay, prior, okay, to the virus, okay, most of these trainings are happening, face to face, okay. People, they take place in a hotel, people travel into Dubai, into Riyadh, wherever it might be. The trainings happen on a face-to-face basis. The online or the live virtual training, okay, the emphasis on this now has really moved, okay, as a result of the COVID-19 crisis. So obviously, okay, obviously the live virtual training tries to replicate the face-to-face training as much as possible, okay. Is it exactly the same? No, of course not. Okay, just like this this webinar that we're doing now, okay, if you're all sit and gathered in a hall, okay, you know, the feeling of the seminar, etc., everything will be different, okay. However, thanks now to technology, okay, the live virtual training can get very close to the real experience, okay. And in terms of all the techniques and the tools, okay, it's easy to show that all during the live virtual training experience. And of course, there's pros and cons, okay. You know, one of the disadvantages of the live virtual training is obviously you don't have the, shall we say, the physical, you know, face-to-face contact. That's important for some people. You can obviously have technical, you know, glitches, okay, people's internet going down, okay, like this. Advantages is great, okay, you don't have to move from home, okay, or your office, and you get to benefit from the training. The training, it can be recorded, so you can use it to recap and go over parts of the course in your own time. Well, yes, the effectiveness of the training is without doubt. During the 4 days, it's very intensive.
Sorry, Patrick. I think I think you missed the question. What is online trading? That's what Ahmed wrote.
Oh, I beg your pardon. Online trading.
Yes, online
okay,
trading
well,
in real estate.
Online trading in real estate. Okay, fine.
Yes.
Yeah, with real estate, online trading is not something that you're going to find very widespread or common. Okay. And we can use, you know, online platforms are used to promote real estate. Okay. But, you know, it's not so easy to in real estate, okay, based on just the information that you get from a online trading platform. Why is it? Simple answer? Okay, simple answer is due diligence. Okay, due diligence. So, for example, and buy shares in Amazon, okay, or any other type of company, okay. You know, I don't need to do due diligence. Okay, yes, if I want to, I can look at the accounts of the company, etc. You know, stuff like that. A publicly quoted company is already there. You know, you know, if I buy a share in Amazon, I know exactly what I'm getting. Okay, if I'm buying a property, okay, I need to go and physically see. I need to be able to do my due diligence on that property. And with investing in property, got different types of due diligence. You've got financial due diligence, okay? You've got investment due diligence, so do all the figures add up? But then you also have got the physical due diligence okay, remember you're buying a bricks and mortar. So it's not to buy, you know, a property, they will do a valuation on it, okay? They will do a survey on it, okay? So physical due diligence is very important. It's vital for buying real estate assets. So really, online is more about promoting it as opposed to, you know, trading real estate assets. So any other questions, Nicola, that we can take?
Yes. Yes.
Okay, so I'm having a look through the questions here. So just to see if there's any other questions to pick up on. Okay. Somebody here is asking a question from Elshad. Okay, question which says, which region do you think is best and worse for real estate investing currently? Okay. And if somebody doesn't consider other investments other than real estate. Okay. Now, this is an excellent question. Okay. And you know what? I wish I knew I had this answer. Okay. Really, I don't know the answer to this. Which is the best the best to invest in? But I can just talk about things generally. Okay, because it does raise a few important points. This question. One of the big problems when it comes to investing, and I'm talking about investing in general, whether it's real estate or stocks and shares or whatever it might be, people invariably try to identify what is best and then put their money into that particular area. What's the problem with that? The problem is we don't know the future. Okay, we really don't know what area is going to be best. Only in hindsight can we say what is going to be best. We don't have that type of hindsight. So this goes back to the key point of diversification, not having all of your eggs in the one basket. And this is absolutely crucial in today's investment environment. There have been people who have built up sizable real estate investments and businesses, and they've been focused on, let's say, particular cities, particular areas, etc. Okay. And they're now wiped out. Okay, you know, Airbnb is a good example. Okay, you have operators that might have had, you know, a dozen, 50, 100 properties all in one particular city. Okay, could be London, it could be Dubai, whatever. Okay, and we know that the Airbnb market has just been completely pulverized. Okay, Okay, by by the COVID-19 crisis. So you need to be diversified both across different asset classes, okay, and within the asset classes as well. So for example, real estate, okay, you need to be, if we're talking about a large amount of money, you ideally need to be diversified across different types of real estate, different geographical areas, okay, and you need to be diversified across different asset classes as well. And sometimes this is difficult for people, especially in particular regions. So for example, if we take the Middle East, okay, in the Middle East, people love to invest in real estate. They love real estate more than anything else, okay. So if people only invest in one thing that goes wrong in that area, easily they're going to be wiped out. So it's crucially important to be diversified. Also, the other thing is, and I'm speaking from the perspective of international investment. If we're talking about international investment, I think one of the key things that people need to take into account is exchange rate risk. Okay, so if you're investing in a particular country and it's a developing market, okay, what happens to the currency of developing markets, or indeed even most countries, let's say, compared to the US dollar? Okay, so if we look at US investors, okay, take US investors for an example. US investors is often, for them, it feels very difficult to invest outside the US, because once they do that, they're taking currency risk. If you look over the long term, most currencies go down in value against the US dollar. Okay, so for example, if I look, as I said, I run an FCA regulated business in the UK. If I look at returns for clients that have invested in US assets, okay, either real estate or stocks and shares, the returns have been excellent because both markets have gone up over there, and of course, obviously, sterling has gone down. It has depreciated. So definitely, somebody should consider investments other than real estate. I'll give you another example as well. I've got like a friend of mine, okay, who invests in restaurants. He's in the restaurant business, okay, and he's done really, really well with the restaurant business. And we've talked about investment before in the past, and I've said to him, well, you know, really, ideally, you should consider something else and be diversified. But for him to diversify, he can get high returns from investing in restaurants. He knows the business inside out. He knows what he's doing. So by him diversifying, he's going to have to accept lower returns. He's going to have to invest in stuff which has got lower returns. He's got less expertise. But now, so he never diversified. And now, like with the crisis that's happened, you know, all these restaurants in Dubai, they're nearly all shut as a result of what's happened. So this goes back to the issue of not being diversified. Every investment, okay, has got its best before date on it. There's a time to be when it's good to be in a particular asset class, and there's a time when it's good to be out of a particular asset class. So as well as stocks and shares, what you consider gold, commodities, etc., as investments. So just seeing. Okay, I think that has answered most of the questions. Nicola, is there anything else that you want to add or that you want to mention about the course or anything else?
Yes. First of all, I want to thank everyone who attended this webinar. I want to thank you, Partick, for an insightful and very beneficial session. And I also can see some people that were answering the polls that they want some more information on your certified commercial real estate analysis and investment course. I would like to invite everyone who are interested, who want to register for the course, to drop me an email on. You can find the email. It's nikola.dimitrovsky@leoron.com, and I will be happy to share the official outline with you guys. So if you found this webinar helpful and insightful, just imagine the value of attending the course on the 21st of June. Plus, you are getting a certificate which you can use upon your portfolio. It can help you in the future. So thank you all for attending. And if you want, you can download the official outline. We have it here in the handout panel. So if you want to do it before we end the session. That's all from my side.
Yeah. So thanks very much, Nicola. Yeah. Finally, I would just say thanks to everybody for tuning in. I hope everybody had a clear reception, and hopefully God willing, I will see some of you on the course in June. It will be our pleasure. I hope you got some useful information and practical insights on commercial real estate investing. And everyone who's fasting, I wish you really, really well for the rest of Ramadan, and Eid Mubarak, inshallah, God willing, in a few days. Thanks very much to everyone. Thank you.
Yes. Thank you, everyone. Have a nice week ahead. Bye.